I want to start first of all by getting your thoughts on what do you look for in the inflation numbers more? Do you look at the year-on-year, or is it more of the month-on-month trend that is more important to you?
Hello, Wole. Well, I think you look at everything, but in this specific case, what's I think interesting is that if you look at the average of month-on-month inflation rates between February and September, it's 0.7%. And last year, over the same period, it was 0.9%. So actually, it's lower this year, which means that if the same trend continues, inflation year-on-year should continue to fall. I've excluded January because obviously of the outlier.
Yeah, of course, because of the crisis we had in January. But okay, so now let's look at those numbers. 11.3%. I think you were looking at something below 11. I mean, that was your forecast. Where do we go from here? I mean, you've already mentioned that we might see single digits. Is that likely to happen by December in your view?
Well, our expectation was 10.9%. The market view was 11, so we're just marginally above that. I think we're still on track to have single-digit inflation figures. Definitively in the first half of 2013. It's not inconceivable that we reach single-digit figures in Q4 2012, although it's not necessarily a given. But as long as the same month-on-month trend continues, I think we'll eventually get there.
Okay, but what about the impact of the flood? We've been talking about that for a while now. Yep. It's very disruptive for the agri sector in Nigeria. But what does that mean for food inflation, for instance?
Well, that was the big and positive surprise of the September CPI figure. Because if you look at the breakdown, actually, food inflation year-on-year was marginally up to 10.2% from 9.9% in August. And in month-on-month terms, it was 1.1% from 0.9% in September 2011. So it's not really out of trend. And it seems that actually the impact of the floods has been relatively modest so far. So it's not, impossible that you could have some lagged effect in coming months, but it hasn't materialized in the data so far. And let's not forget that actually there's a high base effect in the food time series in December, because food inflation month-on-month was 2.2% in December 2011. So that actually should smooth any upside pressure on that side.
All right, so we're seeing the trend come down. I mean, this is the third month we're seeing the inflation come down in Nigeria. Your expectations for monetary policy, is there any case for monetary easing at this stage?
No, I think, the central bank has already suggested that there won't be any monetary easing at the November MPC, so it's unlikely to happen. And they look at all items less farm-produced inflation, which declined to 13.1% from 14.7% year-on-year the month before, but it's still relatively high. However, in early 2013, this figure is likely to be in single digits. And in fact, when you look at the real core inflation, which is CPI minus food minus energy, right, it's already lower. It's 12.2%. So this one will definitively be below 10% in coming months. So I think there will be room to cut policy rates moderately in 2013. But we don't expect a significant shift in monetary policy, because the central bank still has to protect the exchange rate. It still has to offset loose fiscal policy. So any easing will most likely be moderate.
What about in the bond market? I mean, what changes do you expect there with these numbers? Clearly, we have a lot of foreign investors looking at Nigeria now. They, of course, will have their views for inflation going forward. Do you expect any change in the demand dynamics for Nigerian bonds because of these numbers?
Well, I think it adds to the positive momentum. Most foreign accounts basically expect inflation to slide further. So it is to some extent priced in, but at the same time, we've seen yields back up a little bit in recent weeks. And so, if inflation decelerates further, it should definitively support the bonds. But I think even for local investors, that should probably be a positive signal, because the irony is that we've seen that the pension funds and the local banks are somewhat behind the curve in terms of duration exposure. So it could actually push them to get involved more, which will then lead to a further rally in bonds.